book, and I think almost every other Instagram reel that I see where they showcase a collection of books on money, then this is one book that gets featured. So it's been exciting to read this book with all of our community members. For anybody who is not a part of the Online Money Book Club or joining for the first time, let me share what we do here. So we are women wealth creators of the Women on Wealth community. And what we do is here is we read books on personal finance, investing, habit, and mindset building. Because it is so important that we nurture ourselves every day, and books just happen to be a lovely resource that we can carry with us anytime. We can open it on our phones and read and continue to build ourselves as investors. So inside of that, every Friday we come at 6 p.m. We also have an online book club group on Telegram, and to join that, where discussions happen each day, we share insights from whatever we're reading. And do some exciting stuff in building each other up. So if you want to join that, then the description of this video has a link to join that club on Telegram directly. So do join us in. And I warmly welcome all our community members who are here, the book club members, and we'll begin the discussion. So far, till last week, the goal was to read up till chapter 15. And then we will read a portion of chapter 16 beginning today. But let's go back to how last week has been. How much reading were we able to do? And what insights have we drawn for ourselves from the book? So over to you guys. Please, whoever would like to start the sharing.
Sheetal, I'm just playing catch up. Like I mentioned last week, I was behind my reading. So I finally completed chapter 7. And so, yeah, I'm not there where I was supposed to be, but yeah, catching up. So hopefully next time when we meet, I should have reached where I should have been.
Okay, thank you so much. And, I also have not really been able to complete whatever our target was. And what I realized was that I didn't really plan, that it's not that we declare so many chapters are what we will read. And I didn't go back to look at, okay, how many pages. Some chapters are really small. Some have many pages. So I did not really plan my reading as well. I just, we declared, but so when one day's reading went down, then it impacted is what I saw. So a learning is to really set that, daily goal as well. So that is one thing that I have I've become present to.
This week I have finished the book actually. Oh. So yeah, I mean, it was such an enchanting read, and maybe like one reason why I was so motivated to read it so quickly is because there is so much going on right now in the world that is affecting our psychology, right? With regards to not just the stock market, but maybe the fate of the world also. So it's been like a very good time to read the book, because it's all about the way we think and engage with money, right? And the chapter, like, which was really interesting is that he shares how he invests his money. And it was like so good to read how he invested, because he keeps it so simple, and he also connects it to how he likes to live, which is pretty simple. And his key investments are like in index funds. So I found that pretty interesting as well.
Thank you, Meryl. What about others? So Pallavi, Radha, Sneha, Divya, Megha.
So honestly, this is actually my very first session that I'm attending. So I missed the last one. I was traveling, so I missed it. And I was busy playing catch up with all the other sessions and aspects. So I never got around to it. So I haven't even started. So hopefully by next week, I'll be able to catch up. And meanwhile, I just look forward to listening to everyone and what I can expect to, what I can expect from the book.
Awesome. Lovely to have you here, Divya. Okay, who wants to share? Anybody else? Radha, how's your reading coming along?
Hi Sheetal, hi everyone. I have read 2 chapters. The other day I just took the name from you because I was a little confused because when I went to the bookshop, so this was the one which was on top. So I just wanted to confirm that whether this is the same or not. So I just read 2 chapters and it's nice. It's interesting. Little difficult to understand because I don't read these kind of books. I read mostly the power, law of attraction and all that. So this is little different for me. So it will take a little time to understand me.
Wow. So you have picked up is this your first book on finance?
Yes, it is. Though I am from commerce background, but still, this is the first book from finance. I mean, yes.
Wow, congratulations on that.
Thank you so much.
So the pile is gonna grow. Your money and the book pile, I mean.
Yes.
All right, awesome.
Actually, I have one more book. I don't know because I found this interesting. This is the Warren Buffett way. This one. So I have not started it yet, but I will start.
Looking forward to all the sharings from the books you read.
Sure.
Megha, anything for you, whatever you've captured from the first few chapters you're reading?
Yes, yes, thank you, Sheetal. Like Radha, this is also, for me also, this is the first financial book that I'm reading. And the initial start of it was also very interesting. So it kept me holding on to it that I have to read it. But in the meanwhile, I got hold of a Sudhamurthy book. I'm sorry, but I started reading it because it was much more interesting and an easy read. So I read that one in between. So that is where I went lacking into completing this particular chapters. But now I've trying to catch up. And what I found was that there are very simple concepts which have been shared, which and these are all day-to-day things which happen with us on a daily basis, or maybe they keep happening, but it's just that we are not very observant of them. And those are the things, once you apply to the financial planning that you have, then things will be promisable for you. I really like that chapter on Warren Buffett, how he was able to make money, and how a counterpart of his, who was actually getting those returns, and the timeline of investment that Warren Buffett had, and the other guy did not, started at 50 only. So I mean, that was an interesting part to capture, that how he was able to stay wealthy also. So he knew the trick, and that is how he was able to generate those regular returns, but the other guy could not do it. The figure there that was mentioned in 2 to 3 lines, that was overwhelming. I remember that. So I remember going over that twice to understand that what kind of figure that might have been if the other guy might have made that kind of money also. So yeah, catching up on it. Interesting read.
Wow, thank you so much for sharing. Okay. Sneha, anything for you? Are you able to share?
Yeah, I bought this book long back, but I hadn't started. But thanks to the book club, I've started reading it. So I'm enjoying it. It's nice. Yeah. But yeah, it's been like 1 or 2 weeks. I'm not able to read, but I had started it. I was underlining a lot of points, like very deep it is. Sort of like,
Got that. So thank you. And that's the power of the book club and power of the community, right? It always helps us get back on track. I want to pick up on that conversation we initiated in the club about, from the chapter Room for Error. It's really interesting how even as I have continued to work on my finances and engage in many such financial conversations in the community, but sometimes my mind doesn't go into what could go wrong It just feels like, I am doing so much now, much more than what I had ever done in the past, in the first 10 years of working and earning. So I feel that now nothing can go wrong. I am prepared for anything. And then comes this chapter where it's talking about, what could possibly go wrong, and something that we cannot even imagine. And how do you imagine something that that you can't imagine? What do you prepare yourself for? What could possibly go wrong? And I could only think of, okay, whatever money, because I'm banking on whatever money I am saving and able to invest currently, and so I could only think of the worst thing that could happen right away right now could be that I lose everything that I have been accumulating. Also, if I buy a property and I use up all my money for that, then I will come to zero. Am I okay with that? So then Priyanka Parthi had some interesting things to share, so really opened my eyes to what else I need to be thinking of, and are there some newer actions I need to be taking with regards to how I'm building my portfolio as well. Something was, okay, the emergency fund, maybe I really have to, from what I learned from the chapter, I really have to maybe go 5x on the emergency fund, So these are some, because some things might just immediately show up as well. I'm not prepared. So these have been some of my thoughts. I don't yet know what more I need to be doing to really prepare myself. But this chapter has really got me thinking about, okay, what I'm doing is not enough, or keep asking what could go wrong, and will I be able to sail through? How was this chapter for you, Room for Error?
Not read yet.
As an individual, Sheetal, I don't know, so somebody last year, we were discussing something and somebody told me that, why do you always have to look at the wrong side? For some odd reason, I always think, what is the worst that can happen? I never thought about it like the way, Mr. Housel presents it. But for some reason, I always think, right? And so for me, the worst thing can happen is, which happened to me last year, right? When I told you that I got scammed, right? So it is like, that's the worst thing that could have happened. But to your point, when I read this, I was like, nahi yaar, even for that worst case scenario, you have to prepare something. So that's the point that you are saying, that should I be looking at my emergency funding? Why did I have it blended into my account itself? If I had it kept separately somewhere else, maybe that money would not have been touched, right? So I think that was an eye opener. But I do have a tendency. Now, what happens is the scary part. Somebody can go absolutely negative, कि यार ये तो होगा ही होगा, and then you decide कि let's not do anything because the worst will happen, right? But I think we have learned to come out of it, at least this group. If the worst will happen, let's prepare for it somewhere. So after reading that chapter, I realized nahi, I have to think about how to prepare for that worst case scenario also. It is not about investment dipping from 30% to 10%. It is about just it vanishing away.
Yeah.
Okay. So, but the point is, Sheetal, where do you stop? That was my question. Okay, where do you stop to think about the worst that can happen? Then I went back to what is my enough? Is this much enough as an emergency fund? And then when I was thinking about it last week when I was reading, I realized that maybe I should have some more emergency fund. So then suddenly I was very confused. Okay, then now should I focus again on emergency fund, or I let it be? So my question is, where do I stop thinking about the worst?
An emergency fund for the emergency fund. Yeah, and I don't have an answer, and I think we should all just talk about it, say whatever comes to our mind, to maybe even see what opens up for us. And I am thinking of a situation like my cards are always my backup plan, right? Okay, if nothing, if I don't have cash and I have cards, so what if I lose all of those, at the same time? Because I still tend to, usually we carry the ones that we. So I'm just trying to think of what are the worst case scenarios that you have imagined. Please share so that we can prepare each other. Loss, emergency fund being wiped out all of a sudden, as in something happened and you had to use the entire emergency fund. And then what are we then going to break our assets? Are we then going to wait for the emergency fund to get built? So what are the other worst case scenarios, guys? Let your imagination run wild.
None of what I'm saying is going to come from the book, but I think and I completely understand what Garima is saying, that it's never really enough. You think that, okay, if someone goes into hospital, I need 50 lakhs, but then what if the treatment is worth 1 crore? Like, it's never ending. But I think as humans, we have to realize that we can't defeat everything. We can't solve for everything. And that is the reality of living life. There are things you're not going to be able to do, and you have to accept that as a reality. And once you've accepted that, it just becomes so much easier, because then I've made this emergency fund, or I'm going to make it, and then that becomes enough, and you're able to mentally relax. When you relax mentally, it becomes easier. Things happen automatically. But if you keep stressing out about it and keep constantly asking that question, you're so stressed out. You're busy being stressed and not busy actually making money. And the past couple of years, for many reasons, have been up and down for me. And that's one of the things, not money wise, but in many other portions of my life, I've come to realize is you have to accept you can't do it all. That somewhere you have to say, well, this is what I can do. I can do it comfortably. And once you've reached that, you might be able to stretch that sort of comfort line a little bit more once you've reached that line. Something that Owen Wilson, the actor, said, it's one of my favorite clips that I watch. He was asked, who inspires you? And he says, me 20 years or me 15 years down the line inspires me. So he never really gets to the point where he says, now I've reached that point where I'm inspired, because he's constantly pushing himself out 15 more years. So every day, so that's the thing, right? You set yourself a goal, you get there, and then you stretch your goal a little bit more. And I feel like that is a more relaxing way of creating an emergency fund, or creating any fund for that matter, is set yourself a goal, and then once you get there, you stretch it, and then you get there and you stretch it a little more. So that's kind of my thing in life generally.
Thank you so much for bringing this in, Divya. Thank you for the perspective. Garima, I trust that you are supported by that answer.
Yeah, but I was thinking that, when you keep stretching, you are still not defining when to stop. And it's not just about emergency fund, right? हर चीज के लिए होता है कि
there is no stopping, there is accepting.
So I keep going back to the enough, and then I think that, okay, this is my stop, right? But I think by nature, I am somebody who plans exit A, then B, exit C, exit D.
Oh my God, I need to plan my life right down to like the very last thing. But I've also come to realize is for two reasons why that is not always healthy. One is people start depending on you all the time. And I still remember on a vacation when every evening my husband and my daughter turned around and said, what are we doing tomorrow? And I said, wait, wasn't this a vacation for me as well? And that was all because I am the one who does all the planning. And, so one is that everyone depends on you. And secondly, you like psychologically, you're constantly stressing out about it. So difficult to come out of. I'm totally with you on this, Garima. So if you're that person, I mean, it's so difficult to keep reminding yourself that, it's okay to be a little fluid and stuff. But I've also come to realize is that when I was able to do a little bit of it, it was so liberating. Like my mind just went kind of zen. I wasn't, sort of running around like a headless chicken anymore. So yeah, I'm totally with you on like being that person. But maybe baby steps, like with little things, try not to plan and see what happens. And if you're successful, it'll tell you that, if I don't plan that much, it'll be okay. I think people like us just need that little bit of impetus, that little bit of push, that if we don't plan to the nth level, it'll be okay. I'm done.
Thank you. All
Yeah,
right.
thanks.
Anyone else would like to share?
Yeah, there was like one thing which it's said, which was interesting about Warren Buffett and Bill Gates and all of them, that they're very cautious about taking a risk which could lead to ruin, right? And I think that is something a little bit in our control in terms of how we invest our money, or not just invest our money, but like the life choices that we make, right? Like who we marry, and other things, like being like even being in the company of people who could be a bit exploitative or manipulative or something like that, right? So it kind of gives you this sense that the decisions you take have to be taken so carefully, because they can impact your life for 10 years or something like that, right? And I really like this line, the ability to do what you want when you want for as long as you want has an infinite ROI. So I think for me that is very definitive of what I'm really working towards in terms of like the why of it all, partly. So that was pretty powerful.
Thanks, Meryl. And to add to what you were saying, from yes, how much risk do you want to take, and that it does not take you to ruins. And I think from some of the conversations also about how much debt, sometimes we may see that we have the jobs we have and we will be able to pay. That's a definite plan, that okay, where everything is going as per plan. But and then we keep taking more loans, and what if the job is not there? So that's what one example that came to my mind. So thank you. Shall we begin with some reading? Today we said we will start with chapter 16, You and Me. So I invite one of you to read. Who would like to read? I will share the screen. And here you go.
I can read.
Thank you so much, Garima. So while Garima reads, we all can make our notes, and we can share and we can discuss after the reading is done. So take it away, Garima.
You and me. Beware taking financial cues from people playing a different game than you are. Okay. The implosion of the dot-com bubble in the early 2000s reduced household wealth by $6.2 trillion. The end of the housing bubble cut away more than $8 trillion. It's hard to overstate how socially devastating financial bubbles can be. They ruin lives. Why do these things happen? And why do they keep happening? Why can't we learn our lessons? The common answer here is that people are greedy, and greed is an indelible feature of human nature. That may be true, and it's good enough answer for most. But remember from chapter 1, no one is crazy. People make financial decisions they regret, and they often do so with scarce information and without logic. But the decisions made sense to them when they were made. Blaming bubbles on greed and stopping there misses important lessons about how and why people rationalize what in hindsight look like greedy decisions. Part of why bubbles are hard to learn from is that they are not like cancer, where a biopsy gives us a clear warning and diagnosis. They are closer to the rise and fall of a political party, where the outcome is known in hindsight, but the cause and blame are never agreed upon. Competition for investment returns is fierce, and someone has to own every asset at every point in time. That means the mere idea of bubbles will always be controversial because no one wants to think they own an overvalued asset. In hindsight, we are more likely to point cynical fingers than to learn lessons. I don't think we'll ever be able to fully explain why bubbles occur. It's like asking why wars occur. There are almost always several reasons, many of them conflicting, all of them controversial. It's too complicated a subject for simple answers, but let me propose one reason they happen that both looks overloaded, that both goes overlooked and applies to you personally. Investors often innocently take cues from other investors who are playing a different game than they are. An idea exists in finance that seems innocent but has done incalculable damage. It's the notion that assets have one rational price in the world where investors have different goals and time horizons. Ask yourself, how much should you pay for a Google stock today? The answer depends on who you are. Do you have a 30-year time horizon? Then the smart price to pay involves a sober analysis of Google's discounted cash flows over the next 30 years. Are you looking to cash out within 10 years? Then the price to pay can be figured out by an analysis of the tech industry's potential over the next decade and whether Google management can execute on its own vision. Are you looking to sell within a year? Then pay attention to Google's current product sales cycle and whether we'll have a bear market. Are you a day trader? Then the smart price is to pay who cares because you are just trying to squeeze a few bucks out of whatever happens between now and lunchtime, which can be accomplished at any price. When investors have different goals and time horizons, and they do in every asset class, prices that look ridiculous to one person can make sense to another because the factors those investors pay attention to are different. Take the dot-com bubble in the 1990s. People can look at Yahoo stock in 1999 and say that was crazy, a zillion times revenue. The valuation made no sense. But many investors who owned Yahoo stock in 1999 had time horizons so short that they made sense for them to pay a ridiculous price. A day trader could accomplish what they need whether Yahoo was at $5 a share or 500 a share, as long as it moved in the right direction that day. And it did for years. An iron rule of finance is that money chases returns to the greatest extent that it can. If an asset has momentum, it's been moving consistently up for a period of time. It's not crazy for a group of short-term traders to assume it will keep moving up. Not indefinitely, just for the short period of time they need it to. Momentum attracts short-term traders in a reasonable way. Then it's off to the races. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. That process feeds on itself. As traders push up short-term returns, they attract even more traders. Before long, and it often doesn't take long, the dominant market price setters with the most authority are those with shorter time horizons. Bubbles aren't so much about valuations rising. That's just a symptom of something else. Time horizons shrinking as more short-term traders enter the playing field. It's common to say the dot-com bubble was a time of irrational optimism about the future. But one of the most common headlines of that era was announcing record trading volume, which is what happens when investors are buying and selling in a single day. Investors, particularly the ones setting prices, were not thinking about the next 20 years. The average mutual fund had 120% annual turnover in 1999, meaning they were at most thinking about the next 8 months. So were the individual investors who bought those mutual funds. Maggie Mahar wrote in her book Bull. By the mid-90s, the press had replaced annual scorecards with reports that appeared every 3 months. The change spurred investors to chase performance, rushing to buy the fund at the top of the chart, just when they were most expensive. This was the era of day trading, short-term option contracts, and up-to-the-minute market commentary. It's not the kind of thing you would associate with long-term views. The same happened during the housing bubble in the middle of 2000s. It's hard to justify paying $700,000 for a two-bedroom Florida tract home to raise your family for the next 10 years. But it makes perfect sense if you plan on flipping the home in a few months into a market with rising prices to make a quick profit, which is exactly what many people were doing during the bubble. Data from Atom, a company that tracks real estate transactions, shows the number of houses in America that were sold more than once in 12-month period they were flipped rose five-fold during the bubble, from 20,000 in the first quarter to 2,000 to over 100,000 in the first quarter of 2004. Flipping plunged after the bubble to less than 440,000 per quarter, where it has roughly remained since. Do you think these flippers cared about long-term price to rent ratios, or whether the prices they paid were backed up by long-term income growth? Of course not. Those numbers aren't relevant to their game. The only thing that mattered to flippers was that the price of the home would be more next month than it was this month. And for many years it was. You can say a lot about these investors. You can call them speculators. You can call them irresponsible. You can shake your head at their willingness to take huge risks. But I don't think you can call all of them irrational. The formation of bubbles isn't so much about people irrationally participating in long-term investing. They are about people somewhat rationally moving towards short-term trading to capture momentum that had been feeding on itself. What do you expect people to do when momentum creates a big short-term return potential? Sit and watch patiently? Never. That's not how the world works. Profits will always be chased. And short term traders operate in an area where the rules governing long term investing, particularly around valuation, are ignored because they're irrelevant to the game being played. That's where things get interesting and where the problems begin. Bubbles do their damage when long term investors playing one game start taking their cues from short term traders playing another. Cisco's stock rose 300% in 1999 to $60 per share. At that price, the company was valued at $600 billion, which is insane. Few actually thought it was worth that much. The day traders were just having their fun. Economist Burton Malkiel once pointed out that Cisco's implied growth rate at that valuation meant it would become larger than the entire US economy within 20 years. But if you were a long-term investor in 1999, $60 was the only price available to buy, and many people were buying it at that price. So you may have looked around and said to yourself, wow, maybe these other investors know something I don't. Maybe you went along with it. You even felt smart about it. What you don't realize is that the traders who were setting the marginal price of the stock were playing a different game than you. $60 a share was a reasonable price for the traders because they planned on selling the stock before the end of the day, when its price would probably be higher. But $60 was a disaster in the making for you because you planned on holding shares for the long run. These two investors rarely even know that each other exists, but they are on the same field, running towards each other. Whether their paths blindly collide, someone gets hurt. Many finance and investment decisions are rooted in watching what other people do and either copying them or betting against them. But when you don't know why someone behaves like they do, you won't know how long they'll continue acting that way. What will make them change their mind, or whether they will ever learn their lesson. When a commentator on CNBC said, you should buy this stock, keep in mind that they do not know who you are. Are you a teenager trading for fun, an elderly widow on a limited budget, a hedge fund manager trying to shore up your books before the quarter ends? Are we supposed to think those three people have the same priorities? And that whatever level a particular stock is trading at is right for all three of them? It's crazy. It's hard to grasp that other investors have different goals than we do, because an anchor in of psychology is not realizing that rational people can see the world through a different lens than your own. Rising prices persuade all investors in ways the best marketers envy. They're a drug that can turn value conscious investors into dewy eyed optimists, detached from their own reality, by the actions of someone playing a different game than they are. Being swayed by people playing a different game can also throw off how you think you are supposed to spend your money. So much consumer spending, particularly in developed countries, is socially driven, subtly influenced by people you admire, and done because you subtly want people to admire you. But while we can see how much money other people spend on cars, homes, clothes, and vacations, we don't get to see their goals, worries, and aspirations. A young lawyer aiming to be a partner at a prestigious law firm might need to maintain an appearance that I, a writer who can work in sweatpants, have no need for. But when his purchases set my own expectations, I'm wandering down a path of potential disappointment because I'm spending the money without the career boost he's getting. We might not even have different styles. We are just playing a different game. It took me years to figure that out. A takeaway here is that few things matter more than with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are. The main thing I can recommend is going out of your way to identify what game you're playing. It's surprising how few of us do. We call everyone in investing money investors, like they are basketball players. All are playing the same game with the same rules. When you realize how wrong that notion is, you see how vital it is to simply identify what game you are playing. How I invest my own money is detailed in chapter 20, but years ago, I wrote out, quote, I am a passive investor optimistic in the world's ability to generate real economic growth, and I'm confident that over the next 30 years, that growth will accrue to my investments, unquote. This might seem quaint, but once you write that mission statement down, you realize everything that's unrelated to it. What the market did this year, or whether we'll have a recession next year, is part of the game I'm not playing. So I don't pay attention to it, and I'm in no danger of being persuaded by it. Now let's talk about pessimism.
Let's pause here. I love this chapter. So what are the insights? What are the learnings from this chapter? Anything that you would like to share? I'll have to go back to it. I think, now I'm beginning, the more we talk to, so we often say that we are long-term investors. So that's the long-term investing is the game I am a part of, I am playing. So I am not a trader is also another identity, right? Okay, I don't trade, but I am a long-term investor. So I'm clear that that's the game we're playing, and hence our strategies are very different. The actions we take are very different. Something I'm present to is where I'm beginning to see how the new, and a lot of women are now getting into, they're wanting to be stock investors or traders, and they're new, they're coming in, they aspire to be stock investors, and then a lot of the new investors, people who want to get into investing, they ask a lot of questions, and one of the question, and I've been sharing this now because it's so frequent that I hear this question from them, where it's about, okay, what is the best instrument to invest in? What is the what is the best price? How much should I be investing? Not realizing that there's a lot more information that's required, and a lot more inquiry about who you are, what you do, what you want, so all of those things which we are not aware of. We don't even know that these are questions which I need to ask. We just know I want to invest, and you tell me where to invest, that's it, but that's not the game, right? So I can see more of these now. I am becoming present to these questions and the conversations, and all of these come from a place of, they also want to jump into wealth creation. So if you have people who are beginners, then I think we can start from there by really helping them see what are the kind of questions you maybe want to ask to begin with, like, well, how much should I invest? Instead of that, maybe a question could be, how much should I be investing for my goals? But start thinking about goals, so these are some things that come to me. Any other insights, any questions?
Now I realize how Meryl was able to catch up on the book. It's a very good, simple, interesting read and very crisp points.
This was my experience the first time too. You read this book, it's about, you just read, you don't even have to read it out loud. Just with yourself, it's that kind of a book.
Yeah.
It's actually unlike, so I've never read any finance books except in 11th and 12th grade, the commerce and accounts book that I read. But you always have an idea about finance or money related books to be very severe and very tough to understand. But if this is what they're like, then I could read them. And honestly, I haven't even started the reading. I haven't started reading the book, and I've only heard what Garima has read, chapter 16. But it feels also like, oh my God, this is common sense. Why do I not know this already? Why hasn't someone mentioned this? Or why haven't we spoken about this? Obviously, what is good for someone else is not good for me. Doesn't everyone always say that? Like, don't we say the same thing to our children all the time? When they come to us and say, I want this chocolate because that person has it, and we say, well, it's okay for them, but it's not okay for you. Why do we not talk about money and investment and finance in exactly the same way? So, now I feel like a fool for not knowing this earlier.
I think the writer just has a way of articulating it, and also I think the other thing is that we don't openly talk about money to even say that, doesn't it make sense, or shouldn't we be thinking like this? So
yeah, and it is like so interesting to that journey of finding out your own identity as an investor, right? Which is why, like, doing all the WOW programs related to the stock market, they kind of push you to really go deeper into your relationship with money, and also do all this work in understanding how your instrument is making money for you, right? And he makes a reference to these bubbles, the crashes that happened, etc. I think a lot of them also happened because people bought into instruments which had no basis. Like, they were claiming a lot of high returns which were completely baseless, and when they looked deeper into those instruments, they were just trash. so I think this chapter kind of, as you said, like, there's a lot of common sense, but it just helps you really internalize the fact that it takes time for the wealth to grow, and it's better if it grows slowly, based on some really strong foundation, rather than just a lot of market excitement and speculation and all of those things, right? So yeah, it was quite a great way to internalize some of these things.
And just to add to that, something, a perspective about, for example, the about cryptocurrency is just that, at least when we compare it with stocks, now stocks usually seen as high potential, high growth, right? And if you make the right selections, of course, then there comes its competition in making, okay, here's something that can make you richer faster, maybe stronger. But all speculations at this point, all hype. I think we still don't have a good understanding of what the technology is and what it really is. We're just trying to understand right now. And one of the differentiators is that with stocks, there is an underlying asset. There's a business that if the business does really well, then your money will grow. That is there, that relationship is there. Whereas with cryptocurrency, for example, we don't, because we don't understand, we can't even evaluate what its real potential is, what is that underlying assets. Right now, it just seems like, to me at least, a very, very layman sort of observation to me just means it's just riding on people's sentiments currently, right? So just trust, just see that it doesn't become a bubble.
I like the next chapters, that, what do you call it, tagline or something.
Yeah, we
Yeah,
can.
pessimism sounds like someone trying to help you.
So let's read. Okay. This is it.
See, optimism sounds like a sales pitch. Everything is nice, you eat this, you lose 10 pounds. You buy this, you'll get rich. Pessimism sounds like someone trying to help you.
So let me read it for the community. Chapter 17, The Seduction of Pessimism. Optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you. For reasons I have never understood, people like to hear that the world is going to hell. Historian Deirdre McCloskey. Okay. Optimism is the best bet for most people because the world tends to get better for most people most of the time. But pessimism holds a special place in our hearts. Pessimism isn't just more common than optimism. It also sounds smarter. It's intellectually captivating, and it's paid more attention than optimism, which is often viewed as being oblivious to risk. Before we go further, we should define what optimism is. Real optimists don't believe that everything will be great. That's complacency. Optimism is a belief that the odds of a good outcome are in your favor over time, even when there will be setbacks along the way. The simple idea that most people wake up in the morning trying to make things a little better and more productive than wake up looking to cause trouble is the foundation of optimism. It's not complicated. It's not guaranteed either. It's just the most reasonable bet for most people most of the time. The late statistician Hans Rosling put it differently. I'm not an optimist. I'm a very serious possibilist. Now we can discuss optimism's more compelling sibling, pessimism. December 29th, 2008. The worst year for the economy in modern history is about to close. Stock markets around the world had collapsed. The global financial system was on day-to-day life support. Unemployment was surging. As things looked like they couldn't get worse, the Wall Street Journal published a story arguing that we hadn't seen anything yet. It ran a front-page article on the outlook of a Russian professor named Igor Panarin, whose economic views rival the flair of science fiction writers. The journal wrote, around the end of June 2010 or early July, Panarin says the US will break into 6 pieces, with Alaska reverting to Russian control. California will form the nucleus of what he calls the Californian Republic and will be part of China or under Chinese influence. Texas will be the heart of the Texas Republic, a cluster of states that will go to Mexico or fall under Mexican influence. Washington, D.C. and New York will be part of an Atlantic America that may join the European Union. Canada will grab a group of northern states Professor Panarin calls the Central North American Republic. Hawaii, he suggests, will be a protectorate of Japan and China, and Alaska will be subsumed into Russia. This was not the ramblings of a backroom blog or tinfoil hat newsletter. This was on the front page of the most prestigious financial newspaper in the world. It is fine to be pessimistic about the economy. It's even okay to be apocalyptic. History is full of examples of countries experiencing not just recessions, but disintegrations. The interesting thing about Panarin type stories is that they're polar opposite. Forecasts of outrageous optimism are rarely taken as seriously as prophets of doom. Take Japan in the late 1940s. The nation was gutted by defeat from World War II in every way, economically, industrially, culturally, socially. A brutal winter in 1946 caused a famine that limited food to less than 800 calories per day per person per day. Imagine if a Japanese academic had written a newspaper article during this time that said, "Chin up, everyone. Within our lifetime, our economy will grow to almost 15 times the size it was before the end of the war. Our life expectancy will nearly double. A stock market will produce returns like any country in history has rarely seen. We will go more than 40 years without ever seeing unemployment top 6%. We will become a world leader in electronic innovation and corporate managerial systems. Before long, we will be so rich that we will own some of the most prized real estate in the United States. Americans, by the way, will be our closest ally and will try to copy our economic insights." They would have been summarily laughed out of the room and asked to seek a medical evaluation. Keep in mind the description above is what actually happened in Japan in the generation after the war. But the mirror opposite of Panarin looks absurd in a way a forecast of doom doesn't. Pessimism just sounds smarter and more plausible than optimism. Tell someone that everything will be great and they're likely to either shrug you off or offer a skeptical eye. Tell someone they're in danger and you have their undivided attention. If a smart person tells me they have a stock pick that's going to rise tenfold in the next year, I will immediately write them off as full of nonsense. If someone who's full of nonsense tells me that a stock I own is about to collapse because it's an accounting fraud, I will clear my calendar and listen to their every word. Say we'll have a big recession and newspapers will call you. Say we're headed for average growth and no one particularly cares. Say we're nearing the next Great Depression and you'll get on TV. But mention that good times are ahead or markets have room to run or that a company has huge potential. And a common reaction from commentators and spectators alike is that you are either a salesman or comically aloof of risks. The investing newsletter industry has known this for years and is now populated by prophets of doom, despite operating in an environment where the stock market has gone up 17,000-fold in the last century, including dividends. This is true beyond finance. Matt Ridley wrote in his book, The Rational Optimist, "A constant drumbeat of pessimism usually drowns out any triumphalist song. If you say the world has been getting better, you may get away with being called naive and insensitive. If you say the world is going to go on getting better, you are considered embarrassingly mad. If, on the other hand, you say catastrophe is imminent, you may expect a MacArthur Genius Award or even the Nobel Peace Prize. In my own adult lifetime, the fashionable reasons for pessimism change, but the pessimism was constant. Every group of people I ask thinks the world is more frightening, more violent, and more hopeless. In short, more dramatic than it really is." Hans Rosling wrote in his book, Factfulness, "When you realize how much progress humans can make during a lifetime in everything from economic growth to medical breakthroughs to stock market gains to social equality, you would think optimism would gain more attention than pessimism. And yet, the intellectual allure of pessimism has been known for ages." John Stuart Mill wrote in the 1840s, "I have observed that not the man who hopes when others despair, but the man who despairs when others hope is admired by a large class of persons as a sage. The question is, why? And how does it impact how we think about money?" So I think I want to pause here. Let's pause. We have 5 minutes to conclude. I had some thoughts, but let me go back. So anything for anybody, any questions perhaps? Please do bring them as well.
I like this chapter. It's true. No, we'll talk about war movies, we talk about war stories, with apt attention. What can go wrong? Right?
So something I wanted to share was, so I have the ET app on my phone, and I keep getting, and we all keep getting notifications. So it's interesting to see, and now with so much volatility, yesterday the market was down, today suddenly up, you should just see how the headlines keep changing, and the other day there was, I think it was yesterday, where they made it sound like it was Reliance Industries that wiped out so many lakhs of crores of money, So after a while, when you keep reading these updates, then you begin to see through and then say that, okay, I don't need to pay attention to every noise item that comes on my phone, So I've begun to term them as not news, but noise items, because so many, and then, they'll make the same company sound like a hero. Tomorrow, it could make that same company a villain. And that's the nature of media, right? And at the same time, it's the nature of the market to go up and down. So we shouldn't be nervous as long as we have our stocks or our investments are backed up by research and study. Okay. So today we are reading chapter 17. I was also thinking that because many members are just catching up, do we want to slow down this week and maybe keep it till chapter 17 so that we can all catch up, and whoever's just begun can also read as many, because once this is over, then we will pick up a new book, and then so let's just support each other. So I propose that we stick to chapter 17 this week and catch up and keep sharing in the community. Does that work? Okay. Awesome. Great. So in the meantime, maybe Meryl can look into the library and see, hey, what's an interesting read for the book club next? All right.
Sounds great.
Awesome. So yes, let's read till chapter 17. And I would like to have somebody please put it in the book club for your fellow members who couldn't be here today. Let them know how much reading we're going to do for the upcoming week. Okay. And keep reading. So also inviting that, as you pick up this book and catch up, you can use the accountability partnership that we have got going in the book club to just track the amount of reading you're doing. You could just write there, Radha, I read 10 pages today. It's something that we picked up from the previous book, Atomic Habits. So you can always use the book club as a place where you can track how much progress you're making. All right. So awesome. So with that, we complete here. Thank you, everybody. Have a lovely weekend. And yeah, we'll see you tomorrow morning at 9 a.m. all the stock investors. Have a great time, guys. Take care. Bye-bye.
Bye, everyone.